Picture this. You walk into a bank to apply for a mortgage. You've done everything right, 750 credit score, 20% down payment saved up, stable job making $75,000 a year, 0 missed payments in your entire financial history. The loan officer smiles at you, types some numbers into their computer, and 30 minutes later you're approved for a $300,000 mortgage at 5.75% interest. You sign the paperwork feeling proud, because you earned this. You played by the rules. You did everything they told you to do. What you don't know is that the person who sat in that same chair yesterday with the exact same credit score, the exact same down payment, the exact same income, the exact same loan amount got approved at 5.1%. The only difference? They were white and you're black. That half-point difference doesn't sound like much until you do the math. Over 30 years, that's $28,000 more in interest that you'll pay for the exact same house. $28,000 as a penalty for having the wrong skin color. And the most infuriating part, it's completely legal. My name is Alicia, and I spend way too much time digging into the systemic financial traps that keep entire communities poor while pretending to be fair. If you've ever felt like you're playing a rigged game, or if you've been told that racism doesn't exist in lending anymore because we have laws against it, make sure to hit that subscribe button and give this video a thumbs up, because what I'm about to show you will make you question everything you thought you knew about the American financial system. Most people think that lending discrimination ended sometime in the 1960s with the Fair Housing Act. They think we fixed this problem, that banks can't legally charge people different rates based on race, that the system is colorblind now. And technically they're right. It is illegal to explicitly discriminate based on race when it comes to lending. But what actually happens is way more sophisticated than a loan officer looking at your skin color and checking a different box. The discrimination is baked into the algorithms, hidden in the zip codes, embedded in the property appraisals, and wrapped in layers of plausible deniability that make it almost impossible to prove in any individual case. Let me show you how this works with real numbers from real studies, because the data on this is absolutely damning. A 2023 report from the National Association of Real Estate Brokers found that Black borrowers with credit scores above 700 pay an average of 0.5% more in mortgage interest than white borrowers with identical scores, 0.5 percentage point. That's the racism tax, and it applies regardless of income level, regardless of down payment size, regardless of how perfect your financial profile looks on paper. But it gets worse. A study from UC Berkeley analyzed 31 million mortgage applications between 2018 and 2021, and they found that Black borrowers were 80% more likely to be denied a conventional mortgage than white applicants with the same financial profile. 80%. Same credit score, same income, same debt-to-income ratio, but if you're Black, your application is 80% more likely to get rejected, which means you either don't get the house or you get pushed into a higher interest rate loan because you have fewer options. Let me introduce you to Keisha. She's 35 years old, works as a nurse making $68,000 a year, has a 730 credit score, and she's been saving for a house for 6 years. She's got $40,000 saved for a down payment, which is 20% on a $200,000 home in her city. She walks into the bank feeling confident because her finances are immaculate. No credit card debt, no student loans, no car payment, nothing. She's done everything the financial advice books told her to do. The bank approves her for the mortgage, but at 6.25% interest. She's thrilled because she got approved, and she doesn't realize that her coworker Sarah, who has a 720 credit score, 10 points lower than Keisha, got approved for the same loan amount last month at 5.6%. Same bank, same loan program, same down payment percentage, but Sarah is white and got a rate that's 0.65% lower. Think about what that means in actual dollars over the life of the loan, because this is where the theft becomes visible. On a $200,000 mortgage over 30 years, Keisha at 6.25% will pay $246,000 in interest. Sarah at 5.6% will pay $212,000 in interest. That's $34,000 more that Keisha pays for the exact same house, and that's assuming neither of them refinances or moves. $34,000. That's not a rounding error. That's not a small difference you can ignore. That's life-changing money. That's a college fund for a kid. That's a business startup. That's early retirement. That's generational wealth that gets extracted from Black families and transferred to banks as profit. Now, you might be thinking, maybe Keisha had some other factor in her application that justified the higher rate. Maybe there's something else going on that explains the difference. And that's exactly what the banks want you to think. That's the genius of modern discrimination. It always has a technical explanation that sounds reasonable until you look at the pattern across millions of loans and realize the technical explanations always seem to disadvantage the same group of people. The way this actually works is through a combination of factors that all add up to create a system that legally discriminates. Banks use automated underwriting systems that factor in things like zip code, property appraisal value, and neighborhood risk scores. On the surface, these seem race neutral. They're just analyzing data, right? But when Black neighborhoods are systematically appraised lower than comparable white neighborhoods, when zip codes with higher Black populations are flagged as higher risk, when the algorithm is trained on historical data that includes decades of racist lending practices, the output is discrimination with a statistics degree. Property appraisals are one of the clearest examples of this, and the research on appraisal bias is genuinely shocking. A 2021 study from Freddie Mac found that homes in Black neighborhoods are undervalued by an average of 23% compared to similar homes in white neighborhoods. 23%. Same square footage, same number of bedrooms, same condition, same local amenities, but because the neighborhood is predominantly Black, the appraisal comes in almost a quarter lower. Think about what that does to Keisha's loan. If her house appraises for 20% less than a comparable house in a white neighborhood, her loan-to-value ratio looks higher, which makes her look like a riskier borrower, which justifies charging her a higher interest rate. The racism is laundered through the appraisal, and the bank can point to the lower property value as the reason for the higher rate without ever mentioning race. There's also something called discretionary pricing that gives loan officers the ability to adjust rates within certain ranges based on their assessment of the borrower. Studies have consistently shown that this discretion gets used to charge Black borrowers more. A 2018 report from the Consumer Financial Protection Bureau found that Black and Latino borrowers were charged higher dealer markups on auto loans than white borrowers with similar credit profiles, and the difference averaged more than $250 per loan. That's just auto loans. The same dynamic plays out in mortgages, personal loans, small business loans, all of it. Let me show you what this looks like over a lifetime, because the compounding effect is genuinely horrifying. Keisha buys her house at 35 with that 6.25% mortgage. Over 30 years, she'll pay $246,000 in interest. Meanwhile, Sarah bought her house at the same age with the 5.6% rate and pays $212,000 in interest. That's a $34,000 difference just on the mortgage. But it doesn't stop there. Because Keisha's house appraised lower, she has less equity to borrow against if she needs a home equity line of credit. When she goes to refinance in 5 years, the lower appraisal value limits her options. When she eventually sells the house, she gets less money because homes in Black neighborhoods appreciate more slowly than homes in white neighborhoods, even when you control for every other variable. A 2021 Brookings Institution study found that homes in majority Black neighborhoods are worth 23% less than homes in majority white neighborhoods, even after controlling for crime rates, walkability, school quality, and all the factors that supposedly determine home values. So over her lifetime, Keisha ends up with significantly less wealth than Sarah, despite having better initial credit, despite saving more diligently, despite doing everything right. The system extracted that wealth from her through higher interest rates, lower appraisals, and slower appreciation. And if you ask the bank why any individual transaction happened the way it did, they'll have a technical explanation that sounds totally reasonable. The discrimination is invisible in any single case, but obvious when you look at millions of cases. The historical context makes this even more enraging because it's not like this just happened accidentally. The racial wealth gap we see today is the direct result of explicit government policy. From the 1930s through the 1960s, the Federal Housing Administration literally had a policy of redlining. They would draw red lines on maps around Black neighborhoods and refuse to insure mortgages in those areas. Banks followed the government's lead and wouldn't lend there either, which meant Black families were systematically excluded from homeownership during the exact period when the white middle class was building wealth through government-subsidized mortgages. That wasn't ancient history. We're talking about 1968, which is only 58 years ago. There are people alive today who were denied mortgages explicitly because of their race, and their kids and grandkids are still dealing with the wealth gap that created. The median white family has 8 times the wealth of the median Black family in America, and the primary driver of that gap is homeownership rates and home equity. White homeownership rate is about 72%. Black homeownership rate is about 44%, and that gap exists because of decades of explicit discrimination followed by decades of implicit discrimination. When politicians and banks say we fix the discrimination problem, they're technically correct, that explicit discrimination is illegal now, but they're completely wrong that the problem is fixed. The discrimination just got more sophisticated. Instead of saying we don't lend to Black people, the system says we don't lend in neighborhoods with these risk characteristics. And oh, by the way, those neighborhoods happen to be predominantly Black because of the housing segregation we created through redlining. Instead of saying we charge Black borrowers higher rates, the system says we use this proprietary algorithm to determine rates. And oh, by the way, the algorithm happens to produce racial disparities because it's trained on historical data that includes decades of racist practices. Let me tell you about what happened to the real Keisha, the person I actually know who went through this. She got that mortgage at 6.25% and was happy about it for about 6 months until she mentioned her rate at work and her white coworker told her what rate she got. Keisha started doing research, started looking at studies, started at understanding that she wasn't imagining things. The system really was charging her more. So she did something most people don't do. She fought back. She refinanced with a different lender after shopping around aggressively and providing mountains of documentation. She got her rate down to 5.8%, which was still higher than what Sarah paid but better than where she started. That refinance saved her about $60 a month, which is $720 a year, which over the remaining life of her loan is about $20,000. But the process of refinancing cost her $2,000 in fees and took 3 months of her time dealing with paperwork and calls and negotiations. She had to take time off work for the appraisal and the closing. She had to fight for something that Sarah got automatically. That's what systemic discrimination looks like. Not being explicitly told no, but having to work twice as hard and pay more for the same outcome. 3 years later, Keisha is doing fine. Her mortgage is manageable, she's building equity, but she's still behind where Sarah is because Sarah's house in a white neighborhood has appreciated by 12%, while Keisha's house in a Black neighborhood has appreciated by 6%. Same city, same housing market, same time period, but Sarah's house gained $24,000 in value while Keisha's gained $12,000. That's another $12,000 wealth gap that opened up through no fault of Keisha's, purely because of where the houses are located and who lives in those neighborhoods. The most frustrating part about this entire system is how it hides behind technical complexity and makes you feel crazy for suggesting that race is a factor. When you point out that Black borrowers pay higher rates, the response is always, well, that's because of credit scores, or debt-to-income ratios, or property values, or risk models. But when you control for all those factors, and the disparity still exists, when you have studies analyzing millions of loans and finding consistent patterns of racial discrimination even after controlling for every possible variable, at some point you have to acknowledge what's actually happening. What you need to understand is that this isn't about individual racist loan officers sitting in banks deciding to charge Black people more, although that definitely still happens through discretionary pricing. The bigger problem is that the entire system is built on a foundation of racist housing policy, and even though we removed the explicitly racist rules, we never fixed the underlying structure. The neighborhoods are still segregated because of redlining, the property values are still depressed because of decades of disinvestment, the algorithms are still trained on historical data that includes all that discrimination, so the outputs remain discriminatory even when the process looks neutral. Banks love to point to their automated underwriting systems as proof that they're not discriminating because there's no human making subjective decisions, but automated discrimination is still discrimination. If your algorithm consistently produces racial disparities, if it consistently charges Black borrowers more than white borrowers with identical financial profiles, then your algorithm is racist regardless of whether a human is making the individual decisions. Calculate what you're actually paying versus what you should be paying, because this matters whether you're Black or not. If you care about a fair society, if you think people should pay the same price for the same product regardless of their race, then this should make you angry. Take your mortgage rate and compare it to what the average rate was when you got your loan. Look at what homes in your neighborhood are selling for compared to similar homes in whiter or Blacker neighborhoods. Check whether your property appraisal came in lower than expected and whether that affected your loan terms. If you're Black and you're about to buy a house or refinance, shop around aggressively with multiple lenders. Get rate quotes from at least 5 different banks and use them to negotiate. Consider using a mortgage broker who can shop your application to multiple lenders at once. When you get your appraisal, if it comes in lower than you expected, challenge it. Get comps from other neighborhoods, demand a second appraisal, make them justify the number. The burden shouldn't be on you to fight this hard for fair treatment, but until the system changes, fighting is how you protect yourself. Document everything. If you suspect you're being charged more because of your race, file a complaint with the Consumer Financial Protection Bureau. Nothing might come of it in your individual case, but the CFPB uses complaint data to identify patterns and target enforcement actions. Join advocacy organizations that are fighting for fair lending reforms. Support legislation that would require more transparency in automated underwriting systems and limit discretionary pricing. The racial wealth gap in America exists primarily because of housing discrimination, past and present. When Black families are systematically excluded from homeownership, or when they're allowed to buy but charged more for the privilege, or when their homes are appraised for less and appreciate more slowly, that creates a compounding wealth gap that persists across generations. The median Black family has about $15,000 in wealth compared to $184,000 for the median white family, and that gap exists largely because white families own homes at higher rates, and those homes are worth more and appreciate faster. Every extra dollar in interest that Keisha pays is a dollar she can't invest, a dollar she can't pass on to her kids, a dollar that gets extracted from her family's wealth and transferred to the bank. Multiply that by millions of Black families over decades, and you get the racial wealth gap. This isn't ancient history. This is happening right now, today, in every city in America. Every single time a Black borrower with perfect credit pays more than a white borrower with worse credit, the system wants you to believe that if you just work hard enough, if you just follow the rules, if you just get your credit score high enough, you'll be treated fairly. But Keisha followed all the rules. She did everything right. And she still got charged more because the rules themselves are designed to produce racial disparities while maintaining plausible deniability. Black borrowers pay more even with perfect credit because the system was built on racist housing policy and we never bothered to rebuild it on a fair foundation. The discrimination moved from explicit to implicit, from illegal to algorithmic, from obvious to deniable, but it never actually stopped. Every day in banks across America, Black families are being charged more money for the same loans, having their homes appraised for less than identical white homes, being denied mortgages they qualify for, and building less wealth as a direct result. That's not ancient history. That's not a problem we solved. That's what's happening right now while everyone pretends the playing field is level.